Welcome to Science Goes to the Movies, a look at the stories of science and how they change our culture. I'm Lisa Beth Kovetz. In the Star Trek my father watched, the Federation had infinite resources. Money was never really an object for them. But a lot of our futuristic fictions mirror our current frustrations or experiences. And in Star Trek Discovery, the Federation's resources are scarce. So scarce, in fact, that in Season 3, Episode 12 of Star Trek Discovery, Admiral Vance had this to say about how they're powering their food replicators.
It's made of our, you know. That's the base material that we use in our replicators. We deconstruct it to the atomic level and then reform the atoms. It's pretty good for.
And with that in mind, we're going to talk about r/WallStreetBets and the GameStop short sale that became a short squeeze for major hedge fund speculators. Our guest today is Jonathan Peters, author and professor of finance and data analytics at CUNY's Chazanoff School of Business. Welcome to the show.
Morning, Lisa. Thanks for having me. It's a pleasure to be here.
For anyone just returning to Earth from some distant galaxy or tuning into the internet for the first time, in late January 2021, a wealthy hedge fund's planned short sale of GameStop was turned into a hedge fund eating short squeeze by a group of retail investors loosely associated through the subreddit r/WallStreetBets. John, just so everyone's on board before we dive into all the juicy implications, can you give us a quick recap of what's a short sale and how did this one morph into a short squeeze?
Well, again, a short sale is any time someone thinks that the price of a stock is going to drop. And what you essentially do is borrow the stock from someone else with the idea that the price is going to drop and you'll buy it back and make a profit on the fact that you sold it at, say, 50 and bought it back at 20. Now, everybody who does this understands that there's risk to this. It's a decision that you're going to make. But obviously, if you do this, you're deciding that you think the price is going to go down. So that's what happened here, is that some of these major hedge funds had decided that GameStop was in trouble, and it is financially troubled if you look at any of the information on the company, and they decided the price was going to drop. So they were taking a large position, shorting the stock, thinking that the price was going to drop. Unfortunately, they are required by law to make some of this information available, and a bunch of retail investors found out the information and decided to go the other way, which is to buy GameStop shares, and that pushed the price up. And that was where the squeeze comes in, because the hedge fund has to make good on that open position. They had to close it at some point. As the price rose, they have a more and more expensive opportunity to actually, they're going to have to pay more and more to actually close that position.
And all that's legal?
It's all legal, and it happens all the time. And, the thing that's funny about it is I find it very amusing when I'm talking to people on the street. Suddenly my kids in my other classes that are not finance classes are asking me all about stock investing, and it pops up and down. But this is going on every day. And people use it for a lot of reasons. That they may believe that this company is going to have poor performance, and so therefore it's an opportunity to profit. But in this case, these hedge funds took large positions, hoping to profit rather dramatically from the drop in the value of GameStop. And I think everybody on watching can understand that GameStop is a brick and mortar retail store. And I think if you were talking, right, you talk to young people, they're getting their games downloaded, and is a brick and mortar retail game store really going to be a future of this? It's the Blockbuster video. What happened to that when Netflix came in, right? It wasn't a bad idea. I think there's a real reality that the value of this stock might drop.
Does a short sale damage the company that is being short sold?
Well, again, I think it's what it is. And you got to understand, anytime you look at a stock price, the price captures both what's going on in the company right now and expectations about the future. People are making decisions based on what they think the future is going to be. Tesla is extremely expensive in terms of its current performance. Okay, the price earnings ratio, the price of the stock to how much it earns per year, is 1,116. I mean, it's way up there. So people are betting on the future. And now, is that wrong to say that they think there's a future in Tesla? But the point is that that's what we're doing. We're not seeing just what's happening currently to the company, but also the future expectations. And GameStop apparently had not so great future expectations.
But it had great memories for a lot of.
It's nice to have memories, but in finance, we don't have a lot. We shouldn't be an emotional crowd. If you are, you get yourself in a lot of trouble. GameStop's losing money. The current financial information says GameStop's losing money. And so, you have to either turn that around. Now, there may be a future for GameStop, maybe, but you're making a very risky decision if you get involved with the shares.
The subreddit is called WallStreetBets, not Wall Street's steady growth over time. And
Right.
well before the GameStop memes started flooding in, r/WallStreetBets had been swinging for the fences, trying to hit riches by running the riskiest of the riskiest trades. So,
Yes.
John, what are calls and puts?
Calls are basically using options instead of actually owning the shares. What you do is you purchase a right in a case of a call to purchase the shares. So instead of having the full investment value, say $10,000 to purchase $100 a share stock in 100 lot, you just buy a contract that allows you to purchase the stock at some point in the future. A put is an option to sell. So in this case, what people are doing is they're trying to leverage their resources, which is put a small amount of money into their account and get control of a large amount of stock. With options, you got to understand you're magnifying profits, but you're also going to magnify losses. So, you have to be careful about this, because by having a high amount of leverage, you're going to hopefully get a higher return. That's your hope. You might also have them expire because they're only a limited time contract. They may expire completely valueless for you.
And that's also legal outside of Las Vegas?
All this is very standard stuff. It's funny to, again, when I hear it in the press, I'm like, yeah, come to class, I'll happily teach you about it. And the fact is that this has happened multiple times. I mean, I've seen the market have these rattles, and what you have to understand is we call fundamental value. And I'm very old school. When I'm teaching my students, I'm very old school. I teach them classic investment strategies. And what we're always talking about is, what is the real true value of the company? What drives and makes it an important investment or something that you might want to own? People go to McDonald's and buy hamburgers, and that produces profit, and that gets passed on to the shareholders. That's fundamental value, because they sell a product that people want.
If you're over 18, deposit at least $2,000 and prove you're a citizen or resident of the United States. The trading platform Robinhood will be happy to lend you money to trade equal to the money you've deposited,
Right.
No experience necessary. It's one of the largest ratios of lending to assets, but most major brokerage houses will also lend their clients money to gamble.
Right. Well, you remember your brokerage house.
Wait, John, wait. Isn't this what caused the Great Depression in the 1920s?
You got to understand that there's always this mix, okay? And I always tell my students, there's the yin and yang in the markets. It's greed and fear, and we as a group, and some days greed dominates, and other days fear dominates. And so if you're going to invest in a security, there are rules that are set by different agencies of the government to help control this. And after the crash of '29. There was a bunch of rules put in place that have stayed in place to some degree and still are functioning to help control the irrational or unduly risky behavior. And I think everybody watching knows that, when these financial markets blow up, there's generally a hue and cry that we have to save them. And I've talked to the Federal Reserve. I've been to their sessions and talked to them about it. And I'm like, listen, you got to look at who benefits from these types of bailouts. And the reality is that's why we regulate. We regulate in part as a society to kind of control bad behavior. Look at Texas with the electric blow up, right? Regulatory structures should be put in place. So with the margin requirement, that's a Federal Reserve policy, which says if you want to purchase stocks, you must have at least 50% of the value of the stock you're going to purchase. Now, that's not to protect you as the investor. That's to protect the brokerage house. So what they do is they limit how much you can invest so you can't go too crazy. And also, if you fail, the brokerage house should be able to close your account and pay off, whoever not lose a lot of money in your investments. And again, something like a GameStop went from a $12 share, something like that, 130, and then back down to 40 in a very, very short period of time. So if you borrowed money from your investment house, you've got to pay them back. Yeah. And we don't want the financial houses to go up with the stockholders. I mean, people make bad decisions all the time here, Lisa. People buy stuff they shouldn't buy.
Yeah.
But I give advice. A lot of people don't listen to me. And it's one of those situations where be careful. Caveat emptor. Buyer beware. Right.
Let's talk about the brokerage house and the name of the brokerage house. They called it Robinhood, the quintessential underdog protecting.
From Robin. At least I got to figure out who are they stealing from? I don't know. The point is Robinhood was set up and a lot of people get involved. And it's like any behavior. It's like, if you talk about investing, say I was going to talk to you about bicycling. There are people out there that are bicycling casually. Then there are people who are mountain biking. And there are people in the X Games, right? It's all bicycling, but there's lots of different levels of risk. And that's the way investments is. Some of them are riskier. Some of them are less risky. Robinhood is bringing in a group of people, which I think is great to see people have the opportunity to invest in securities. And again, I can point you to a bunch of relatively boring, but conservative stocks that I think if you were thinking about a long-term investment, you might want to consider. Robinhood is saying you should just go in there. And again, this whole idea, this name WallStreetBets just blows me away, because I'm like, we're not betting here. My job is not to bet. I'm not going to Atlantic City when I'm investing. My job is to get as much information and understand the value so that I pick good things to invest in. That's my goal, right? So Robinhood, I don't know who they're stealing from. Like, I'm assuming maybe they're stealing from their investors. They're certainly making profit on the volume of trades they're having, right? That was one of their models of it, is to get a lot of trades going and get revenue. Generally, I would tell everyone in the financial markets, don't look for a lot of, let's just say, egalitarian ideas or the helpful. Robinhood would not be the person I'd be looking for in the financial markets. It's much more an aggressive market of people are trying to look for a profit.
Bigger risks, bigger rewards, bigger drama, more memes, more upvotes. Maybe somebody will compose a sea shanty about you. Members sometimes broadcast their losses, and YouTube is filled with videos tracking and lauding the sudden rise and meteoric fall of mysterious traders with titles like The Legend of Control the Narrative and other YOLO superstars, many with fun, smutty pseudonyms that I can't say because this show is broadcast. But in behavioral economics and behavioral finance, there's something called prospect theory, which posits that human beings value gains and losses differently. But what if the internet applauds you for losing, calls your losses legendaries, and welcomes you into the club of giant losers? And it's not just WallStreetBets. If something awful happens to you and someone has a camera rolling, you can make a ton of money accidentally falling down a flight of stairs. So is social media messing with the basics of behavioral economics?
Well, I think there's always going to be a fringe element that's not investing with any prudence. I mean, the way you could really think about it, the simple way I could describe it to people is these behaviors that these people are engaging in. If you hired somebody to manage your funds, if I was going to manage your pension funds, would you want me to put your money as an investment advisor into say, GameStop? No, you would say to me, that's inappropriate because it's not an appropriate level of risk for the people who are engaged here. Now, if somebody wants to do something crazy, there's a lot of people out there, and the question is free will, right? Should somebody be allowed to do something crazy? If you're going to make some crazy investment and lose all your money, that's a personal decision. But if I was a financial manager, if I was working for a client, I could get some real trouble for me because this would not be what we call prudent behavior.
Yeah, some of the threads of conversation on WallStreetBets read like a love story between gambling and mathematics with a little irregular neuropsychology thrown in to make the relationship spicy. And some of the trades are dizzyingly complex. Are there and have there always been traders with the kind of skill, personality, and time to ride out and enjoy these uber complex schemes?
Absolutely. And the point is, and what I would always say to everybody, and this is a real simple rule, okay? If someone's coming to you with a trading strategy, that's probably a bad idea, because if they had a good trading strategy, what would they do? They would just do it. They wouldn't tell anybody else about it. So some of these theories, people have a lot of different ideas about how they manage their portfolios and how they trade. And there's tons of them. But the key thing is, if you had some strategy that was a clear winner, Lisa, what would you do? You wouldn't tell anybody about it. You just do it. And let me tell you, there are people out there on a daily basis that are doing it. They have models that probably are better than other people, but you don't want to tell anybody else. You just want to make money. Why? You just want to, you're again, Robinhood, maybe if they're Robinhood, but most people in finance I've found, really, we prefer just to, I just prefer to make the money and be done with it.
Again, I got to say, income inequality and a generational divide I think it makes these investors very different for those two very specific reasons. Yeah. But is the big shock that they are retail and not institutional investors?
Well, no, I mean, look, everybody in the retail side, and it's been long known, this is not a new phenomenon. It's just that the trading structures are making it easier for smaller investors to get involved, which I think is great. I mean, it's one of those challenges. If you don't have knowledge and you come into a game, it's to your detriment, right? And so in a sense that if you're going to be involved and engaged with financial markets, you really should learn more. And so really, when I run up against a student or somebody else who wants to talk to me about it, I can't wait to tell them, share some information, because in a lot of cases, they're trading with very, very little knowledge of what, if you're just listening to somebody else on Reddit, you got to be really careful here. And there is a situation where you can learn these skills. These are learnable skills. Now, I'm fighting right now, I'll tell you, my campus to include financial management as an opportunity for a general education, for personal financial management, because these are learnable skills. Now, how many people in America have these skills? That's a real challenge, and it's very, very unevenly distributed. It's more, if you tend to be Anglo households, they tend to have higher levels of education. Males tend to get better education. High income households tend to get better education, which means we do a bad job with women, minorities, and low income households. Why? Because we rely on the households to train people about this stuff. And they don't have the skills. The households don't have the skills. So it's something it's a challenge. I'm excited to hear people are interested in financial markets. I also wish I could help them get some more skills.
In science fiction and speculative fiction, the roles of money seems to be cleanly divided into the utopian worlds of plenty for all, where money doesn't even exist, and the dystopian worlds of shortages and the very, very powerful crushing everyone else on the planet. In your real world opinion, how much of the GameStop squeeze is fed by income inequalities and institutionalized unfairness?
Well, it's funny because I've been talking to some people, younger people, about it. And again, I kind of view this process as a very kind of structured process. I approach it in a very organized way. They're viewing their future not as positively. You know, maybe they have younger people have a more dystopian view of the future, that they're not going to have opportunity, that there's not going to be chances for them to get ahead in the world. Therefore, you know, when you have little in terms of opportunity, maybe throwing the dice and you know, taking some risk on is less unpleasant, right, for you as a household. That may be motivating some of it.
There are memes that say we have no future anyway, so risking the future we don't have, okay, right. We're okay with that. But you teach finance at CUNY, and a lot of your research focuses on the economics of public work. So back to that Star Trek issue of the replicators, scarcity and poop. Is income inequalities and institutionalized unfairness changing everything?
Well, I'm really kind of pleased right now that we're having a much better discussion about inequality. I've been doing a bunch of work in this area, and you know, it's two sides of the coin for me, right? I'm a professor of finance. I teach all about financial markets, but I also talk a lot about how our society divides up our resources, right? And I think, again, I think it's actually a very good place to be, because you need to have the skills and understand both sides of it to really do some interesting work in inequality. But, you know, it's funny, in the future, in a lot of cases, I watch these science fiction movies and I kind of go, well, you really didn't understand the economics there, or they didn't really have it clear. Some things in the future may sort themselves out. You know, we don't think about the technology progress that suddenly lowers the cost of an item. I'll give you lighting, right? Back in the 17th century, 18th century, you know, lighting was a big deal. Having a candle or having an oil lamp, that was an expensive thing, and it took a lot of effort. Nowadays, we have LED light bulbs, you know, and LEDs suddenly drop the cost and the amount of energy. You know, our electric bill becomes less and less an important component. Can I see a future where, with the right technologies, energy might become very, very cheap? Possible. Look at internet. Look at our use of computer technology, right? The volume of information we pass over the internet is radically higher than it was even only 20, 30 years ago. I worked at telecom. I was at AT&T Corporation. You didn't have this amount of volume. Price of that has gone way down. So it's possible in the future with technology, some of the aspects will come down. Now, it's possible some resources will, and in a lot of movies you find, right, you see these kind of worlds where you're fighting over this one critical resource, you know, and then there's this big engaged discussion about how to achieve it. And in that case, there may be some constraints. So it will be interesting to see how it does play out. But we forget a lot of times how much technology improves, right, our ability to purchase resources and to have resources that are not really critical or you know, constrained.
Well, you're right in line with Robert Solow, who won a Nobel Prize for saying that technology needs to be included in the calculation of GDP. Was it a GDP?
Right, measurement of because it's skipped over. I mean, autos are safer today; they're more fuel efficient. You know, these are things that tend to be kind of washed out. But I think like lighting and electricity is a good one to show people, right? Because you know, 30 years ago, lighting was an expensive thing. Nowadays, you put your LED lights on, and you know, the amount of electricity you're consuming is just minimal, right?
Right.
That's a new technology. We're not going back, because once we figure that one out, we're like, why would we build these other things? These old electric light bulbs. Why would we do that? That's crazy.
WallStreetBets is the absolute opposite of a monolith. It's made up of a multitude of different individuals, but there does seem to be a ribbon running through it that speaks of a willingness to risk their whole future for the possibility of gain because the future is not bright. You teach kids, and your students are also not a monolithic single personality. But what do you think about that sense that our future is worth risking because it's all dystopian?
I think there's a long history of risk in society, and there's always people who take on a bit more risk. There are people who are adventurous people and people who engage in extreme sports, right? We've always had that contingent, and the argument some people make, I think, is that behavior is beneficial when risk brings back positive outcomes, right? And so in a sense that I really think that it's important for us to talk about giving out the skills to make people more capable of living in the modern world, right? And I think it's, there may be some changes coming from it. Reddit is all about our instant information. In the old days, it was very difficult to get information about financial markets, and it's very difficult to get information about what was going on. Now these people can share. These people are sharing information, again, freely. Now, whether or not it's good or bad, that's a whole other question. But they're able to collaborate and discuss things, which wasn't really a standard situation in society, even again, 20, 30 years ago. So that could change the way people interact. I personally, I wasn't sitting at home crying when I heard that the hedge funds had trouble with the Reddit trades. That didn't bother me in the least, because they weren't showing up. The hedge funds weren't there for the good of humanity. They were there to make money. And if their trades went bad on them, I'm kind of very philosophic. I'm fine to let them do it, but I certainly don't think it's a public problem. And for the young people, they may feel that this is a reasonable risk to take on given their future prospects of the future. I think their prospects may be brighter, and hopefully I can help them understand why I think there are opportunities, and I think there are huge opportunities going forward. Careers and products and things that are going to go on in the future, we don't even have a real grip on. We're going to see a lot of changes in the economy, and the key is to be well prepared and obviously make good strategic decisions. So I'm not a big fan of this kind of idea of, dystopian world, roll the dice. I'd be much more saying, how do I strategically move through this game? You see, that's the way I move.
In season 1, episode 11 of Seth MacFarlane's The Orville, Commander Kelly Grayson explains to Lieutenant Commander John Lamar that once we could all synthesize whatever we wanted, we no longer had any need for money, and that the value once assigned to money changed.
Exactly. It became obsolete with the invention of matter synthesis. The predominant currency became reputation.
So, currency, money. What is money?
Well, money typically is a store of value. There's a reason that we have monetary systems, and they're pretty old. They go back, at least 10,000 years. There's always been this idea of trade. Money is a facilitator. It's a place to store your value traditionally. It's a place where you can facilitate transactions. It's much easier to carry money than it is to carry goods and services. In the old days, we'd barter. We'd exchange goods for goods. It's very complex. It's very, very, cumbersome to have to carry around, whatever, watermelons or wheat or whatever to do your trade, but much easier to carry something convenient. And so money had that role of storing a value and also allowing us to do these transactions. So that I don't think is going away, right? Because things may become cheaper, right? Like, electricity or energy in general, that may become cheaper, and therefore it may be priced much more conservatively. There still will be some resources. I'm thinking in the future there'll be resources that are scarce, and then you'll still want to have a monetary system that allows you to hold value, right, and use it in the future. Joseph Conrad, the philosopher, said money is congealed power. I like that. That's a kind of good way to. So you tell me what that is, but it's once you put the value into it, it has the ability to achieve goals and objectives, right? You can take your money and use it to force a problem, to solve things that you see are important, right?
That's fascinating.
Yeah, I like that one. Congealed power, right?
Yeah. And this kind of leads right into the idea of blockchain currency like Bitcoin, and my favorite proof that funny is money, the Dogecoin. In internet slang, a doge is a dog, and most doge memes feature a particular Shiba Inu named Kabusu giving some happy side-eye to his newly adopted owner. On December 6, 2013, software engineers Billy Marcus and Jackson Palmer put that meme dog's face on their new cryptocurrency, which now has a market capitalization of over $5 billion, plus a shout out from Elon Musk. And I haven't lost any money on Dogecoin, so I'm very comfortable finding the whole irony is money hilariously funny. But is our sense of what's valued skewed, or is this just what humans do?
Yeah, no, listen, people put their money, people put resources into all sorts of assets. And I'm not able to tell you completely what is going to have value in the future. I mean, there is a dimension of supply and demand. If something is desired, I mean, apparently Dogecoin was just this joke of an item, but people want it. And there apparently is a limited number of them. So you have to acquire one that's out there. Prices of assets depart from the real value all the time. And how far they depart depends on how many people want it. You know, when you go to an auction house like a Christie's or a Sotheby's and you watch them buy some item, you know, a painting, I look at it, I'd say I wouldn't pay $50 for it. And it goes up 100, you know, 200,000, 800,000, 5 million, right? How high does the price go? It depends upon who wants it. So any sort of asset like a Bitcoin or a Dogecoin, I'm going to wonder, why would someone want to have it?
Well, do you think we'll ever reach that Orville or Star Trek world where there is no actual money?
I'm highly suspicious that there will always be scarcity in some way. And then you also have to think about how you reward people's effort and motivation. Now, if we have no need for human effort, maybe then we'll have to just figure out a way to compensate people for maybe good behavior. I don't know. But again, people generally don't disappoint me. I generally rely on bad behavior, and they generally, as an economist, don't disappoint me. But, you know, you think about things that are coming at us. You know, you think about 3D printing, right? And you think about this thing we have on Star Trek called a replicator, right? You're starting to gun in here. We're not that far, but as the cost of producing goods and services goes down, right? Then obviously you can have more assets. Of course, in our society, it's kind of funny. We have so much stuff nowadays. That stuff is a burden as well. People have to have storage sites to store all this stuff. And really today, in some cases, we have an excess of goods. You know, in a lot of cases, look at the number of toys we have in our household. Look at the number of clothing, right? The amount of clothing we have. So, you know, it is interesting. I think there will be scarcity in the future. I think there will still need to be a store of value in the future. I don't see that going away.
Professor Peters, we are out of time. Thank you so much for joining us today.
It's been my pleasure. Lisa, thanks so much for having me on.